Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Tuesday, June 14th, 2022. Hope your week is off to a great start. A lot has changed in the market in a short period of time since we spoke last week, so we want to update you on some of the important economic data that we've seen over the last couple days and over the weekend, the impact that it had on the markets, and what it is likely to cause the Federal Reserve to do when they wrap up their policy meeting tomorrow and give us a policy announcement at 2 p.m. Eastern Standard Time. So first, the CPI last Friday, we spoke about it 2 days prior to. We told you what our expectations were. We told you the best case, then the worst case, and we told you what we did not want to see in that CPI report was evidence that inflation was accelerating. And unfortunately, that is exactly what this report showed on Friday. Not only did it come in higher than the previous month, but the rate of change of inflation continues to accelerate. Now, as energy prices continue to spiral higher, this is pushing inflation higher. It's pushing the consumer price index higher. And naturally, we are seeing higher readings. So what this set off was a cascade of selling in the market, because as inflation has continued to move up, even in the face of a lot of economists' expectations, expecting it to roll over, we also expect that inflation will roll over. We think it has peaked, but again, with those energy prices inside the core CPI, there's a lot of components that inflation has peaked and have come down, but the energy component continues to go up, and that is overweighted in the CPI. Therefore, we are seeing higher and more elevated readings. So it set off a cascade of selling in the market because now the people, investors, anticipate the Federal Reserve is going to get even more aggressive. Now, we think this is a welcome change with the Federal Reserve. Now, what this has led to is a lot of speculation that this week, instead of moving at a 50 basis point or a 0.5% interest rate hike, the Fed's going to go straight to 0.75%. Again, we think this is a welcome change in the market because right now we have two major credibility issues that the market is dealing with. We have a Federal Reserve that has no credibility because first they printed trillions of dollars, didn't think it would create inflation, then told us inflation was going to just go away, then did an about face and acknowledged that inflation is a problem, and now they're saying to the world, don't worry, we got it, we know how to navigate this. Now, I do think the Fed will get through this, but you can't fault investors for feeling a lack of faith and confidence in this Fed to navigate us. And the other lack of credibility and crisis of confidence we're having, the market is having right now, is with the current administration. Now, it is only fair to say that President Biden did not cause all the problems that we are dealing with today. Many of these problems came from COVID-era policies that needed to be done at that time, emergency-era policies, but it is really hard to think of a single thing that Biden has not made worse. And it's that lack of confidence, that display of confidence that we want to see from our president, from our administration, that don't worry, we got this under control, we have a path forward. The markets are just not seeing that right now. And as inflation continues to spiral out of control, with energy being the number one component driving it higher, there are plenty of ways the administration could affect and positively impact this fuel crisis that we're seeing right now, but unfortunately, they do not have the political will to do it. So that's just the facts. That's just the way it is. We will find a way forward without the help of either of those bodies. But nonetheless, the Fed finally getting serious about inflation is a good thing. Remember, rate hikes in their nature are bullish for stocks. Now, I understand in the current environment, right, it hasn't looked very bullish because we're fighting the inflation dragon. But when we take a look at data compiled from all days where the Fed hikes interest rates in the market, right, going all the way back into the early 90s, we see that on balance, markets tend to like interest rate hikes. They tend to rally on interest rate hikes. And further, when we look at how markets react on an intraday basis on days when markets hike, we see that this yellow line, which represents interest rate hikes of a 0.5 percentage point or more, are actually very well received by the market, right? So again, this time is a little different, right? Because the economy is softening. We're hearing a lot of rumors and news from corporate America about large scale layoffs, right? So I think it would suggest that the U.S. either is already in a recession or is moving towards one, but the likelihood is the market has rushed to price in this recession already, to price in this Fed policy, and that is why we have seen declining prices the way that we have. So let's take a look at the market, okay? This is the 3-year view of the market. Again, zoom out, right? 3-year view of the market, not so scary, folks. You know, we had a huge advance off the COVID low, and now we are doing what markets do, which is giving back some of those gains, right? 2 steps forward, 1 step back, rinse and repeat. Everything is going to be just fine. But of course, when we zoom in, things don't look as good, and that's why we encourage you folks to keep your perspective on this. Don't get sucked into the day-to-day. But here's our market, right, with our moving average line in the middle. And again, markets started to move up into their moving average, and it looks like some nervous sellers decided to just jump the line, not even wait to see what would happen if the market ran into the moving average CPI number. And unfortunately, this is what it looks like when the market is at an inflection point like it was, and we get a bad economic reading like we did with the CPI on Friday, right? Not even any wait and see, just sell first, ask questions later. And this is a very big move in 4 days, right? You rarely see 4 consecutive days with 1% declines or greater. So it got us thinking about, had that ever happened before? And we decided to look into some of the data, and this is what we found, okay? It doesn't happen very often, right? The only time we've seen more than 4 consecutive days with 1% losses or greater was actually back in 08, where we got 7, right? And that was the max. And with where the market sits right now, with about 16 minutes to close, it doesn't look like today's going to be a 5th 1% decline in a row. But moreover, when you look at the returns, 3, 6, and 12 months out, they are overwhelmingly positive. Now, we don't pull this data together just to give you a rosy picture and some false hope. We show you this because this type of activity suggests that markets are trying to bottom, right? They're trying to bottom. That's what happens. You get accelerated selling, you get a climax in fear, and you get capitulation. We've been looking for it. We've been waiting for it. It hasn't happened just yet, but an important threshold was breached yesterday that will probably go a long way to helping this market. And that is, we finally, officially, right, according to the media, entered a bear market. Now, these are just terms, labels, folks. They really don't mean anything to us, but I'm going to explain it because it's being spoken about a lot in the news. Anytime markets fall 20% from their peak, it is considered a bear market. Now, if the markets had only gone down 19.5% instead of 20, would you feel any better as an investor? Probably not. But the label of bear market starts at 20% and lower. The reality is many stocks, thousands of stocks throughout the market, have been in a bear market for 6, 8, 10, even 12 months. Okay, so the bear market, even though as far as the S&P 500 is concerned, started yesterday, we think now the indexes are just playing catch up to a lot of stocks that have already been in a bear market. So what we expect to see, what you can expect to see, as the indexes make new lows here, we expect a lot of stocks in the growth side of the market have already seen their lows. The May 12th low that we spoke about at detail in a lot of these videos, we think those stocks will hold up better. They saw the selling first, and now they're starting to see the buying first. And that is how the stages of these corrections unfold. First, we see different stages of progression on the way down, and then we'll see different stages of progression on the way up. So when you look through the portfolio and you look at some of the growth names that are still 5, 8, 10, 15, 20% above their May 12th lows, while the indexes are at fresh new lows, that is positive divergence, would suggest to us that the pain on the growth side of the market, much of it has likely been felt. And not to say prices won't go a little bit lower, but what we know historically, when bear markets happen, when corrections happen, when crashes happen, it's the NASDAQ and the growth stocks that tend to bottom on average 2 to 3 months before the S&P 500 and start to lead the charge higher. So that's the type of activity we'll be looking for. But nonetheless, tomorrow, big Federal Reserve meeting, expect a 75 basis point hike from the Fed. We think that is good, that they are getting serious about tackling inflation. We think the market will like that they are getting serious about tackling inflation, because what this will tell the market is that we are not on some preset collision course where we have all our rate hikes planned out into the fall and into the winter. We are essentially being flexible and reacting to the data as it comes in. And a CPI print like we saw last Friday warrants the Fed to go harder and faster. And overall, even though the day-to-day reactions in the market seem like it's scared of interest rate hikes, we think that that will go a long way to taming inflation and letting the markets get back to focusing not on the Fed, but on profits, earnings, revenues, and their forward-looking guidance, which is what the most important financial metrics are when you own stock. So again, nothing has changed in the game plan. Day-to-day movements in the markets, people call up, markets are lower than they were yesterday. Have you changed your mind? Have you changed your view? Are we going in a different direction? Folks, nothing has changed. This decline has been a little bit steeper than many of us anticipated, but the likelihood was after a massive run off the COVID low, a 5-wave advance, we were going to get a 5-wave decline, and we believe we are in the final stage of that decline here. Whether it's done, whether it goes another 2%, 3%, 5%, the worst, the bulk of it, we believe is already behind us. So keep that in mind. Keep your eyes on the horizon. Just know that behind these storm clouds, the sun is shining, and there will be good days in the market again. There's a lot of fantastic investment opportunities in this market right now. Big quality U.S. companies that have come down a lot in price that we have wanted to own for quite some time. We are finally going to get the opportunity to do so. So don't fret. We will not let this opportunity go to waste. But if you have any questions, reach out to us. Always here to talk to you about anything that's on your mind. We hope you have a great day, and we'll see you back for the next Heritage Market Update. Take care.